Welcome to Kaiser Watch with John Kaiser. I'm your host, Jim Goddard. John, what's coming up on today's show?
Well, we're going to talk about the latest financing activity statistics for the TSX Venture resource listings for May. And we're also going to talk about Hercules progress report and what it means.
What do the latest financing activity statistics tell you about the resource juniors?
Every month, the TSX Venture publishes a monthly review bulletin in which it includes all the private placements, short offering memoranda financings, and IPOs that have been done that month. And I process this data, crunch it up, and it also becomes part of my each company's Kaiser Research online profile where you can see what financings were done. So I've been tracking this information since 2002, and it really provides, the graphics that I've created provide tremendous insights about what's going on. Now, last month, about $224 million was raised by private placements, $53 million by the short offering memoranda, which are free trading right away, and that compares to $261 million last year in May for the private placements and $97 million for the short SOMs. Now the May was better than April, but the levels for the first half of 2024 are weaker than they were last year in the first half. Now, the second half of last year was absolutely dreadful, and it remains to be seen what happens later this year in terms of financing activity by these juniors. Now, what's interesting is that the flow-through component, the value raised by flow-through financings in May, was unusually low. And that's interesting because you're supposed to spend the flow-through money that you raise in the year that you raised it, or eventually you end up having to pay penalties. And with a big expiration season coming up, you would think that April, May would have been good flow-through financing windows for at least Canadian expiration. Last year, that got messed up because so many areas were closed because of the forest fires, some areas just in terms of access, but a lot of expiration couldn't happen because the equipment that's needed to support exploration drilling, such as helicopters, they had been requisitioned to help with the firefighting effort. So far this year, we do not yet have a major forest fire problem impacting exploration plans. But maybe what's also happening is that this a capital gains tax proposal, where anything you make above $250,000 ends up being taxed at a higher rate. Flow-through financing typically comes from high net worth investors or individuals, and it's used as a tax deferral strategy. And because the cost base becomes zero and you're taxed on whatever you do manage to sell your flow-through stock at as a capital gain, this development may be crimping the demand for flow-through financing or shares in Canada. But we really don't. We'll have to see what's going on. Now, in the charts that I've presented, and for those of you who go to my website and look at the Kaiser Watch blog report, you'll see all these charts that I've put together for from 2019 to 2024. And there's some interesting insights that one can glean from this. For example, the money seems to be mainly going into $1 million plus financing. And 60% of the value raised was in the 20 cents to dollar range. And interesting, very little at higher prices, which is quite abnormal. And the number of financings done below 10 cents, that has surged, which is not surprising, but it's nowhere anywhere as bad as it was in January, where it seems every little rinky-dink company scrambled to do a small financing. If you do it below 5 cents, that can only be done either with a pity waiver from the stock exchange or in conjunction with a rollback, where it's 10 for 1, you do a financing at 1 cent. It's actually a 10-cent financing by the time the rollback and the financing is done. But I've got one chart which shows the number of financings done to price range as a percentage. And if you look at it, you can see that we're trending back to 2019. Now, 2019 was a very bad financing year for the juniors, and you can see by the shift in the number of financings in these lower ranges, and these are typically financings less than $500,000. These are essentially survival financing, and that's also consistent with the trend away from flow-through. You cannot spend flow-through dollars on your fancy dinners and other overhead. It has to actually be spent on exploration, and companies that get audited and it's found out that they spent it on other things, they end up having major penalties. So right now you can tell that with the shrinkage in the flow-through financing activity and the number of small financings, these are staying alive type financings. Now, in terms of warrants and non-warrants, there is a distinct trend to financings with warrants. We're also starting to see 3-year warrants or even longer now being demanded. And that reflects the gloomy near-term to medium-term outlook that the market has adopted. They want those warrants to last a long time. Now, in the short offering memorandum group, there was $53 million done by 3 companies, and 2 of them, Kootenay Silver and Frank Justra's West Red Lake Gold, they raised $43 million, but they also had warrants, and that's unusual because in these types of financings, it's usually done without a warrant. Now, I've got one chart which has an interesting piece of information in it, and that is that the vast majority of financings that were done without a warrant, private placements and otherwise, are in the 30 to 50 cents range. So there's all kinds of interesting tidbits that you can get from this. Now, I also have a graphic which shows the distinction between value raised by companies engaged in discovery exploration and those engaged in feasibility demonstration. And this graphic goes all the way back to 2002. And the feasibility demonstration, which refers to companies that have a flagship project that has a resource estimate already in place, and they're now trying to demonstrate that this can be put into production, find out what the costs are, what it would end up being worth, and net present value type of thing, hopefully either be funded for the capex to put it into production directly, or get acquired by a bigger company which has the capital to fund the capex. And there was a shift that happened in 2020 where all of a sudden the balance, the proportion that goes into discovery exploration became the majority. And this has continued to be. Now, I speculate that the reason this trend has happened is that the feasibility demonstration type financings typically come from an institutional audience. But the institutional audience has to a large degree vanished. Now, in the 2000s, we had the China super cycle, which dragged up metal prices substantially above where they were, delivered major real prices, which meant all these marginal deposits that had been discovered ages ago, they were suddenly in the money. And the institutions could see that the driver of it was China coming into its own as a major economy, expanding the global economy, and therefore total metal demand. And they could crunch the numbers. They could see that this was going to be profitable, so a lot of money poured in. Even though we have, say, copper and gold trading near recent record highs, this has not seemed to move the needle with regard to attracting institutional capital, and that's because the gains have been modest, relatively modest. To get the institutional money interested in feasibility demonstration, there needs to be a dramatic upward move in the price. Now, what could cause that? Well, I've been arguing for the past few years that there are 2 major drivers. One is the geopolitical conflict between global East and West, and I've got a graphic that breaks down how much of all the metal and energy commodities the global South, global West, and global East nations produce. And the global West nations, which are pretty much the democracies and also collectively the biggest economic chunk of global GDP, they have a minority share of supply. So if this global East, global West conflict actually gets hot and metals stop flowing, there is a serious problem. But it seems like the global West nations don't understand any of this. We still see in Canada, we have the UNDRIP consultations holding up progress, becoming like, you have to make sure that there isn't anything that disturbs the First Nations group in an area before you grant a drill program. And never mind that there might be a seasonal constraint to the exploration window. And in the United States, you have this massive not in my backyard lobby run by environmentalists who have their head in the sand about what's happening globally and will do everything they can to block any sort of exploration and mine development in the United States. And that's, of course, makes it difficult for resource juniors who do require a timely approval of drill programs so that it can coincide with funding cycles. And that's sort of one reason I think the Canadian resource junior sector is busy fading away. Now, we've got several favorites that have been dealing with these permitting issues. Last week I talked about Arizona Gold, and it's a record of decision on its FONSI for the BLM land. That's part of its Philadelphia project. But even after this is granted, there's still these fussy things that have to happen, and somebody has to go to these two drill pad locations and make sure there is some tortoise not living in that area that's on the endangered list, even though these two drill pads are like a tiny, tiny footprint of the entire area. And we're still waiting to hear from Solitario that all the government agencies and the U.S. Forest Service have signed off on their record of decision that allows them to drill at the Golden Crest project. We're hoping maybe by after the Canada Day and Independence Day week, they can start drilling. And with PJX Resources, which is doing a modification of an existing drill permit, we're still waiting to hear when this is going to happen. They had been hoping to be drilling by June, but according to John Keating, no, we're still doing all these consultations. Hopefully after this sort of Canada Day, Independence Day weekend, we will have something there. But on the plus side, their application that they are applying for is a substantial one that will, if they do make a discovery at Dewdney Trail, and that can either be a zinc, lead, silver SEDEX discovery or a copper gold intrusion related discovery, they will be able to continue drilling for quite some time, perhaps even several years, delineating this. So the wait is worthwhile. And he also says this year the snowpack has been considerable, and there's still snow on the mountain. In the same breath, he says, well, with proper preparation, we can also drill in winter. So we'll see. Hopefully, we hear soon that that project is that permit is in place. And Solitario and PJX, these are companies that, as this market continues to not be interested in metal prices because they're sort of flatlining, not ramping up, and nobody believes these crises such as a hot geopolitical conflict or even the energy transition requirements or the requirements of the AI boom in terms of additional critical metal supply. They don't believe it's actually going to be an issue. Right now, you have to focus on plays that have big discovery potential and are funded to do so. And most companies aren't properly funded to do anything. Solitario and PJX are, but nothing can really happen until they have those permits in place. So financing activity, it's pretty slow. It's probably not going to get better in the summer. Last year, everything got even worse in the fall. We'll have to see this year if the trend is different. It would be helpful if we had some major discoveries to spark market interest.
Why did Hercules Silver slump after its recent update?
Hercules Silver started a 20,000-meter drill program on May 6th. On June 20th, they reported an update and said that they had managed to complete 5 holes. 3 of them were in sort of the northwest part of the Hercules target areas. They'd done a big 3D IP survey in 2022 that became the basis for this blind copper system discovery that attracted a $23 million financing at a premium from Barrick Gold. They then expanded this 3D IP survey and realized that this system is even much bigger than they had imagined last year. And so the market was expecting that the first few holes would instantly provide gratification. Well, they've had several problems. One is they have to drill through what's called the upper plate, and that is the rocks that host the zinc, lead, silver mineralization that has been the focus in this project for many, many decades. But this is actually a thrusted chunk of rock sitting over the lower plate rock, and the lower plate is where the big copper porphyry system is located. And the whole goal now is to probe through the upper plate into the lower plate and find where the rich copper mineralization is. Now, last year's discovery hole number 523-5, that indicated that at that depth there were copper grades sufficient to support block caving. And the scale of the target said this is a large system, and this of course is what attracted Barrick. It's also what stimulated interest in a much broader region because there's these younger thin veneer of basalt flows that have obscured everything, and the big companies now realize, in this part of Idaho and I guess part of Oregon and Washington, it also has potential for big copper systems. But the first 3 holes, the first one I didn't even mention, but number 2 and 3 they did describe, it appears to have intersected what they describe as the lithocap, which is the upper part of a porphyry system, which is usually weakly mineralized. And they explained that this implies there is some sort of fault offset that has shifted the underlying richer mineralization. So although the first 3 holes have been submitted for assaying, the market realized, there's no great assays coming for that. But the other problem is drilling through the upper plate has been a huge pain, very difficult, very slow. They've got 3 rigs going, and they've only completed 4 holes plus a 5th with the number 7, and that one they had to abandon before they even got into the lower plate. And this was a major 1-kilometer step out to the south, and they encountered so much water from the aquifer, and apparently because of the heavy moisture this past winter, the aquifer is supercharged, so they had to abandon that hole. So they've got now 2 important holes in progress, number 5 and 6. This steps to the south of the discovery holes from last year. This is new territory, and they're drilling one towards the southwest and one towards the northeast, trying to understand what's going on there. One of them just managed to get into the lower plate last week. The other one's still working on it. These are the holes that one should be watching for very carefully. And the third rig is moving to drill pad number 8, and holes 8, 9, and 10 are back in the northern part where they're now trying to adapt to what they learned with those first 3 holes, that there is some sort of northeast-southwest structural control which has offset the mineralization, and so they will be probing into that. But the market is in such a bad mood. If it doesn't get instant gratification, it's out of there, and the stock was pounded down. It was down to 50 cents on Friday, and there isn't really much we can do at this point except wait. But they've got $24 million in working capital. They've got still 17,000 meters left of the 20,000 meter program to drill, and with the exploration season having just begun, we should be able to hear from them that they finally figured out the geometry. But the market reacted negatively because the company still does not understand the geometry of the high-grade portion of this system, and it has to be high-grade because it's too deep to be open pit mined because of that upper plate thrusted rock over the top, which is several hundred meters thick, and so that's basically the limit of open pit mining. So Hercules slumped because this update did not deliver instant gratification for a market that's in now glass half empty mode and expecting that, well, if the first few holes didn't deliver success, don't count on the rest doing it and just back it in. Good bottom fishing opportunity.
John, thank you so much for the update.
You're welcome, Jim.
We've been talking with John Kaiser. I'm Jim Goddard. Comments made on Kaiser Watch are an expression of opinion only and should not be construed in any manner whatsoever as a recommendation to buy or sell any financial instrument at any time. Archived online at kaiserresearch.com.